Insurers have significantly ramped up their private placement bond holdings over the last decade to $1.4 trillion at year-end 2019. And here to talk about the trends with investment class is Jason Hopper, Associate Director, Industry Research and Analytics, and Brian Keleher, Associate Analyst. And Brian, we're going to start with you. With the significant ramp up of private placement allocations, what advantages are insurers looking for with these investments?
As interest rates continue to be at historic lows, insurers are attracted to private placements because they provide a higher return than what's available in the public market. Private offerings also don't need to be registered to the SEC, allowing insurers to save on fees. In addition, private placements allow insurers to customize each deal and choose the investors with whom to do business. Private placements have more restricted covenants with tighter levels for minimum debt and coverage ratios, offering downside protection to insurers. Strong covenants alone do not justify in investing in a weak company. Insurers must be selective and attentive once the investment is part of their portfolio, with proactive credit monitoring and ongoing reviews of covenant compliance. Lastly, private placements can provide extra diversity versus the public market, as private issuances often target different sectors and issuers. For example, the public utility sector is not heavily weighted in corporate bond portfolios, but represents a higher amount of private placement.
Now, Jason, with the pandemic and related volatility, are there greater risk to insurers with these holdings, and what are insurers doing about it?
Sure, John, thanks. I would start off by saying that over 90% of private placements are rated investment grade, more than half of which are rated NAIC 1. But obviously the pandemic does bring risks, not only private placements, but throughout every single asset class for the most part. While it hasn't come to pass yet in any sizable scale, we may see downgrades as companies see reduced revenue and just overall heightened financial difficulty related to the economic ramifications from the pandemic. Downgrades would ultimately lead to higher capital charges, more so from NAIC 2s dropping to NAIC 3, as opposed to 1s dropping to 2s and staying within the investment grade bucket. But nonetheless, those charges are possible. As Brian mentioned before, covenants are key for protection and do limit the downside risk, and violations can trigger default. However, insurers do have some flexibility and can offer waivers or renegotiate the terms rather than force impairment, which should ultimately lead to better recovery rates. Now, unlike the financial crisis of 2008, where bad decisions from management led to impairments, it's widely understood that the repercussions from the pandemic are no fault of management, which could lead insurers to be more inclined to work with the issuer and achieve those better recovery rates.
Brian, is there a particular industry segment that favors these investments more?
Yes, the life and annuity segment favors private placements, accounting for a majority of the total insurance industry holdings, with continued growth over the last 10 years. Reasons for the large exposure in this segment is life and annuity insurers have less concern about liquidity aspect with longer duration liabilities, as they have more of a buy and hold strategy. In addition, life and annuity companies use investment income as the main driver of earnings, so the extra yield is a large incentive for them. Conversely, for the PC and health company insurers who are more concerned about liquidity, they tend to hold a higher percentage of 144A bonds compared to life and annuity insurers. Due to 144A holdings being more liquid, the PC and health segments prefer them over non-144A private placements, since most of their lines of business are short-tailed and these holdings can better match with their liability profile while providing a slight bump in yield over corporates.
So, Jason, what does AM Best expect going forward?
We do expect continued growth, although it may be a little bit more moderate than the past decade. Private placement requests are down 15% through July for US and Canada, so there is less supply throughout the market. But as Brian mentioned before, private placements do provide diversification, and higher allocations now may be near the upper end of the investment guidelines for some companies with the growth over the last 10 years. But in any regard, insurers will continue to monitor portfolios to see where issues might arise, or if they have availability to continue to add more to their portfolio. Proactive credit monitoring, ongoing reviews of credit compliance, and periodic valuation analysis will all be necessary going forward for the insurance industry.
Thanks, Jason. Brian?
Thanks, John.
Thanks, John.
was Jason Hopper, Associate Director, Industry Research and Analytics, and Brian Keleher, Associate Analyst. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.